Internal auditors must determine whether fraud risks require special consideration during an engagement. Although management is primarily responsible for preventing and detecting fraud, internal auditors are expected to maintain awareness of fraud risks throughout the audit process. Fraud risks may significantly affect engagement objectives, audit scope, testing procedures, and reporting requirements. Therefore, auditors must incorporate fraud considerations into engagement planning and execution. The program emphasizes recognizing fraud risks during planning and assessing processes that may have significant exposure to fraudulent activities. Effective fraud risk consideration helps auditors identify areas requiring enhanced scrutiny and supports the organization's efforts to strengthen governance, risk management, and internal control processes. 1. Recognizing fraud risks during engagement planning. Fraud risk assessment begins during engagement planning, when internal auditors evaluate the likelihood that fraud could affect the area under review. Auditors consider factors such as the nature of operations, prior fraud incidents, control weaknesses, incentive structures, management pressures, organizational culture, and industry-specific risks. Planning activities may include discussions with management, review of risk assessments, analysis of prior audit findings, and evaluation of fraud-related indicators. The objective is to determine whether fraud risks are significant enough to require additional audit procedures. Early identification allows auditors to allocate resources appropriately and design engagement strategies that address areas of heightened exposure. Effective planning ensures that fraud risks are considered proactively rather than discovered unexpectedly during audit execution. 2. Assessing processes with significant fraud exposure. Certain organizational processes inherently present greater opportunities for fraud and therefore require special consideration during engagements. High-risk areas often include cash handling, procurement, payroll, inventory management, vendor selection, expense reimbursement, financial reporting, and information technology access management. These processes frequently involve valuable assets, complex transactions, or opportunities for management override of controls. Internal auditors assess whether adequate preventive, detective, and corrective controls exist within these areas. They also evaluate segregation of duties, authorization procedures, monitoring activities, and reporting mechanisms. Understanding which processes are most vulnerable enables auditors to focus audit efforts where fraud risks are greatest. Risk-based assessment improves audit effectiveness and increases the likelihood that significant fraud exposures will be identified and addressed. 3. Impact of fraud risk on audit procedures. When fraud risks are determined to be significant, auditors may need to modify the nature, timing, and extent of audit procedures. Additional testing, expanded sampling, data analytics, document verification, surprise reviews, or increased management inquiries may be appropriate. Auditors may also devote greater attention to unusual transactions, manual journal entries, override activities, and areas where controls appear weak. Professional skepticism becomes especially important when evaluating evidence related to fraud risks. Internal auditors should critically assess information rather than relying solely on management representations. The goal is not to conduct a criminal investigation, but to obtain sufficient evidence regarding fraud-related exposures. Enhanced audit procedures help ensure that engagement conclusions adequately address areas where fraud risks may materially affect organizational objectives. Auditors first plan by considering fraud risks during engagement preparation. They assess organizational processes to identify areas with significant fraud exposure. Next, they prioritize high-risk activities requiring enhanced attention and allocate resources accordingly. Finally, they examine these areas using appropriate audit procedures and professional skepticism. A useful exam principle is that not all engagements require the same level of fraud-focused testing. The level of consideration depends on the significance of identified fraud risks. Applying the PAPE framework helps auditors determine when fraud risks require special consideration and supports effective, risk-based engagement planning and execution. Internal auditors are expected to possess sufficient knowledge to evaluate fraud risks and recognize indicators of potential misconduct, but they are not expected to have the expertise of professional fraud investigators. Their responsibility is to assess whether fraud risks are adequately managed and whether controls are designed and operating effectively to reduce exposure. When significant fraud indicators or control deficiencies are identified, auditors should communicate these matters through appropriate reporting channels and recommend corrective actions. By integrating fraud risk considerations into planning, assessing vulnerable processes, and applying appropriate audit procedures, internal auditors contribute to stronger governance and risk management. This proactive approach enhances organizational resilience and helps protect assets, reputation, and stakeholder trust.